they've been pretty fine throughout this entire situation. If anything, the rates give them more money, and the ongoing deficits are generally going toward Medicare, Medicaid, Social Security, defense. A lot of it is also basically an interest expense. A lot of that's flowing to the upper ends of the income spectrum as well. Um, Whereas where that's been challenged is anyone that's younger looking to buy a home is obviously kind of pressured in that market. We see fairly low volumes across that sector. It's ongoing just sluggishness because people generally don't want to sell unless they have to, and people are kind of waiting to buy and kind of constrained from buying. And so I think that's contributing to the kind of the K-shaped economy that we see right now.
While everyone is glued to the upcoming Fed meeting, Lyn Alden warns that the real danger isn't just monetary policy, it's fiscal policy. Over the next few months, the Treasury is set to inject more than $600 billion into the economy, triggering massive liquidity shifts. This isn't just another economic ripple, it's a tidal wave that could reshape financial markets in ways most people won't see coming. And who benefits? The same people who always do. Those who already own assets, real estate, equities, fixed-rate debt, are sitting comfortably, watching their wealth inflate effortlessly. Homeowners with locked-in low-interest mortgages are effectively getting richer as rising rates crush new buyers. The housing market is a wasteland of unaffordability, trapping an entire generation in perpetual renting, while the asset-owning class consolidates even more power. This isn't a flaw in the system, it is the system. A K-shaped economy where the wealthy ride the waves of liquidity while everyone else fights to stay afloat. But in the midst of this engineered chaos, a quiet revolution is unfolding as Bitcoin emerges. It's a decentralized, finite asset beyond the reach of manipulation, untethered from reckless policies and economic distortions. History won't be kind to those who ignored the signs. The scam is unfolding in real time. And you're either on the right side of it, or you're the mark. As we bring you clips from the interview, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for joining us again. Enjoy the video.
We have the same momentum that we had in 2024 and really much of 2023 for that matter, which is decent liquidity conditions and ongoing fiscal dominance in the US, which is leading a lot of things to run hot, ranging from nominal GDP to asset prices. And a couple of the key things I'm watching for 2025 is basically anything that would change the course of that or give us some wiggles along that path. And so one of the things I'm watching first and foremost is the debt ceiling issue. Not because I expect much out of it in the long run in terms of all the defaults and stuff that can happen, but rather because when the debt ceiling's being contested, the Treasury has to do extraordinary measures, which they started this week. And that basically means that they have to drain cash from their account back into the system in order to keep paying their bills without issuing net new debt. So the longer that goes on, that's a liquidity factor, which can then translate into asset prices and other things like that, financial conditions broadly. And then also the one of the biggest things to watch is tariffs. That's potentially an all year thing to watch, but especially in the first few weeks and months here to see any sort of announcements around that. So I get a lot of questions around what's the Fed going to do. We obviously have an upcoming Fed meeting, but in this era of fiscal dominance, I pay a lot more attention to some of these other factors, even though, of course, Fed decisions still matter. But at the end of the day, fiscal matters a lot more. Well, so historically, I mean, the debt ceiling was not used for a negotiation tool for most of its life. Ever since the global financial crisis, it started to be used more. We have a fairly small sample size of presidents since then, and most of those president terms have been Democratic presidents. And so it's mostly a tool that Republicans use against Democratic presidents. We didn't really see Democrats use it against Trump in his first term. And now we might see Republicans use it against Trump. But to answer your question, my base case would be to see not very long because of that, the fact that it's all intra-party. And he's got a very strong position within his party kind of culturally and in terms of allies. So if this were to go on kind of as the 2023 debt ceiling did, and then I believe the 2021 debt ceiling, it could potentially go 5 months or so, kind of, be a dominant factor for much of the first half of the year and drain that 600 billion plus back into the system over the course of the better part of half a year. Um, that's basically if you leave it as it is now, no ability to lift the debt ceiling, ongoing disputes, and then they have an 11th hour fix to it like they've done prior. That's kind of what would happen. But I expect it to get handled more quickly than that because of the fact that it's all intra-party. So it's something that I don't think all that liquidity is going to get drained in the system, but until we see progress on the debt ceiling, the TGA will start, gradually draining back in. So if you back up a little bit, back in 2022, that was a very negative liquidity year. The Fed was draining liquidity, and also the Treasury was not really providing liquidity. But ever since we saw the issues in 2023, partially around regional banks, but then also the rising yields and things like that, we started to see the Treasury increase its issuance of T-bills, and that allowed them to suck liquidity out of reverse repos and back into the system. And so, really, for about 2 years, we've seen the Treasury almost perfectly offset the Fed in terms of liquidity. So the Fed's still doing quantitative tightening, but the reverse repo facility is draining back into the system at almost exactly the same pace. Um, and so when you kind of look at aggregate measures of domestic liquidity, it's been almost perfectly flat. It just kind of trends sideways ever since 2023. But that's got a time limit to it, which is there's only so much left in the reverse repo facility for that to happen. And the last 2 quarters, we have seen increasing amounts of kind of strain under the surface. So the repo facility was tapped in quarter 3, window dressing, and then it wasn't really tapped in quarter 4, but we saw kind of initial funding stress leading up to it. Basically, it was expensive for different institutions to get the liquidity they needed during window dressing. If we take the TGA out for a second, we probably should expect that by mid-year or so, we run into some, pretty serious liquidity constraints in the system. We'll get kind of updates probably each quarter to see what does funding stress look like. Did anyone have to tap the repo facility, the Fed's repo facility, and things like that? But yeah, most indicators show that we're kind of pretty close to the liquidity floor in banks. And the Fed's probably going to go back to, not doing quantitative tightening this year at some point, and either have a flat balance sheet for a little while or go back up to kind of gradually increasing their balance sheet, only in terms of treasuries, while probably continuing to let off mortgage-backed securities from their balance sheet. And if you bring back in the TGA for a second, that could extend the current situation a little bit if the TGA does end up draining entirely into the system. And then you'd have issues when they go back to refill it. Now, still not my base case that it's going to be drained, but that's more of a political question. So that kind of does throw a curveball into things for the first half of the year. But either way, by the second half of the year, we're probably going to see liquidity constraints in the system.
Lyn Alden has been keeping a close eye on the U.S. economy, which has been experiencing good liquidity conditions and remains economically dominant. This has increased nominal GDP and asset prices, which show no signs of slowing. Alden is particularly interested in the debt ceiling issue, not because she believes it to have a large influence in the long run, but because of the Treasury's need to implement extraordinary measures. This entails draining cash from their account to continue paying bills without issuing new debt. The longer this goes on, the greater the impact on liquidity, which in turn affects asset prices and financial conditions. She points out that Republicans have historically used it as a negotiating tool against Democratic presidents. However, the current conflict is an intra-party matter, and the president's strong position inside his party may result in a faster conclusion. Tariffs are another source of worry for Alden, particularly in the early weeks and months of the year. Any announcements or changes in this sector could have a substantial impact on the economy. Let's watch more clips from Lyn Alden's discussion.
How are you thinking about that tension between basically the short rate income versus the long bond yield obligations? And obviously those have been increasing in recent months. We've seen, the 10-year bond yield go up by 100 basis points. So how are you thinking about that tension today?
So I think it's partially why there's a disconnect between kind of the wealthy and the less wealthy, or the asset owners and the non-asset owners, because anyone who entered this period with a lot of assets and with a home, either that they own outright or with a fixed rate mortgage on it, they've been pretty fine throughout this entire situation. If anything, the rates give them more money, and the ongoing deficits are generally going toward Medicare, Medicaid, Social Security, defense. A lot of it is also basically an interest expense. A lot of that's flowing to the upper ends of the income spectrum as well. Um, Whereas where that's been challenged is anyone that's younger looking to buy a home is obviously kind of pressured in that market. We see fairly low volumes across that sector. It's ongoing just sluggishness because people generally don't want to sell unless they have to, and people are kind of waiting to buy and kind of constrained from buying. And so I think that's contributing to the kind of the K-shaped economy that we see right now. And now that I kind of view it as range bound. So during the rapid increase in interest rates, this was a really powerful effect that was happening. Now I think it's kind of absorbed. We've seen, banks have kind of absorbed a lot of the initial unrealized losses they had. We obviously some of the really problematic ones got cleared out, but now it's just kind of slowly being absorbed into bank capital. And then also I think the same thing's kind of happening on balance sheets around, which is that now it's kind of range bound, so it's less of a, kind of a fast hitting factor and more of this background thing that's happening. And that's also why I categorize rate changes as so relatively inconsequential compared to other things because one, it's fiscal dominance rather than monetary dominance. So whether or not you get extra several $100 billion in deficit spending or not is a much bigger impact than a few basis points. But then also the Fed cutting the short end doesn't necessarily translate to similar moves on the long end, which is where a lot of businesses and consumers are actually borrowing from in terms of new loan origination. It also this kind of point to the kind of ineffectuality of the Fed here, because if you just kind of back up and say the Fed's tools to manage inflation are almost entirely geared around bank lending and exchange rates, basically. So if they raise rates, the goal is to kind of slow down bank lending, make borrowing more expensive, and also to harden your currency compared to potential foreign currencies, so foreigners don't pull money out of your economy. So those are kind of the two levers. But in the current era, this entire 2020s period, we never had excessive bank lending. Bank lending was not the driving factor of inflation like it was in the 70s. And instead, we had monetized fiscal deficits. And raising interest rates doesn't do anything against monetized fiscal deficits. Now, they can push back on monetizing it to some degree. But at the end of the day, if they see dysfunction in the treasury market, they always step in to fix it. And so their tools are not really geared around that. And that's why it's ultimately more of a fiscal thing. Now, the Fed they can kind of indirectly tackle that by saying, well, if fiscal is running hot and is therefore contributing to inflation, we can run bank lending at below average to try to offset it. We can say, okay, if bank lending is normally at X, we can slow that down to maybe run at 70% of X. So you have a little bit sluggish bank lending and therefore slow down money creation that way. But then all you really do is shift where the driver of the economy is. You're almost kind of like unfairly slowing something down because fiscal's running hot. And so that's kind of the big challenge that they face. And it just kind of shows that the whole model doesn't work as well as it's kind of intended to when you have fiscal dominance, which is why this period is kind of just structurally, we need different ways of thinking about it compared to how we analyze markets for much of the kind of the past 40, 50 years. I think that the main moving parts there are if we had gotten a Harris victory, then we would have had to more seriously consider some of those Trump era tax cuts expiring, going back into effect, which would have been effectively a tax increase. Now, because we get the Trump victory, those are less likely to be allowed to go back in. They're more likely to be either extended or made permanent in some fashion. And so that's basically all else being equal, a deficit contributor. But then on the other hand, now we have to seriously consider tariffs to some degree. And those are tricky because to what extent are they taxes on the American people versus taxes on foreign businesses? The proponents of tariffs would like to say that it's going to come out of the profit margins of the foreign producer. But a lot of, especially physical goods, a lot of profit margins are 10, 20, 30%. So if you put 20% tariffs on someone, they're either going to not sell to that market or they're probably going to increase prices to some degree. And so we could see additional revenue from I believe they call it the external revenue service. So that could balance it out. I still think tariffs are one of the biggest things to watch because we don't know the magnitude yet. We've seen kind of the opening statements, kind of what the initial side of the negotiation. But where do those actually land in practice? Really remains to be seen. I generally would take the under, just because I think it's an administration that'll be very careful of market disruptions that are abrupt, but we'll see.
The relationship between short-term interest rates and long-term bond yields is an important part of the current economic environment. According to Lyn Alden, this conflict contributes to the inequity between the rich and the poor. Those who started this time with significant assets and fixed-rate mortgages have remained relatively undamaged and, in some cases, have even profited from the rising rates. On the other hand, younger people trying to buy a property face significant market pressure. The Federal Reserve's ability to manage inflation is equally restricted, as its tools are mostly focused on bank lending and currency rates. In the current period of fiscal supremacy, these measures are less effective, forcing the Fed to address inflation indirectly by limiting bank lending. However, this technique has limits, as it may unfairly slow down particular sectors of the economy. Tariffs are another important component of the economy, and Alden believes they are difficult to negotiate. While proponents believe that tariffs will reduce foreign producers' profit margins, Alden points out that this may not be the case, and tariffs may instead result in higher prices for American consumers. The scale of tariffs has to be determined, and Alden is concerned about their potential economic impact. The Fed's instruments are inadequate to address the root causes of inflation, which are driven by fiscal policy rather than monetary policy. As a result, the Fed is forced to use indirect methods to combat inflation, which may have unexpected consequences. As we wrap up, what do you think is the most pressing economic issue facing the U.S. today, and how do you think it should be addressed? Please drop your thoughts in the comments below, share this video, and hit your thumbs on the like button. Thanks for watching. Don't forget to subscribe.